Welcome to the podcast where we discuss all matters financial planning and investing. This content contains general information only and may not be relevant to everyone. Please contact our office to make sure and determine if this is relevant for you.
Hi and welcome. I'm David Loughlin and I'm joined with my co-host Cole Eccles. How are you, Cole?
Good and yourself, Dave?
Good. Today we're talking about a topic that we talk about probably all day, every day. And, a lot of our clients come to us with questions around sort of superannuation. And, sometimes a lot of people feel like it hasn't worked for them. Quite like they thought, and other people it's worked extremely well. What would the difference be between those two people, do you reckon?
I think the one is someone who takes an active interest in their super. So one, obviously, understanding, where it all is. You don't have multiple super accounts. You know where it all is. You understand what it's invested. You take an active approach to investing, and you're actively adding money to it other than your employer contributions going in.
Yeah. So one of the big things is, should I be adding more money to my super? And if so, there's actually multiple ways that could happen, isn't there?
I think the first one about should you is, again, we talk about it all the time. It's not a yes or a no, depending on your life stage, what other things are. But generally, it's better to add a little bit more than the 12% your employer's putting in or the standard employee contributions over the longer term, because that's going to get you, to your financial independence quicker. But in terms of how you put it in, again, that depends on your individual circumstances. So, you can put money in before tax or after tax, depending on what your taxable income is and your situation is, would depend how you actually, or which contribution type you actually use.
Yeah, there's a lot that a lot of people don't talk about with super contributions. Like, you got the normal one through your boss, and most people know that one. But there's business sale exemptions. So there's a lifetime cap on you. If you sold your business, you can actually put up to $500,000 in there if you qualify and you're around those rules. Then you've got downsizer. So if you sell your house and want to downsize and get some money into super. What else is there?
Downsizer, there's spouse contributions.
Spouse contributions.
So if you got one spouse and low income, there's tax offset you can use. So there's spouse contributions. There's, you mentioned downsizer. There's just your normal after-tax contributions. There's contributions that you make that you claim a tax deduction personally. So there's a whole
there's a whole bunch of them. Hey, and it's like, which one do we use and why and how? And so once you actually, I always find if you make a decision that you want to actively manage your super and get some more money in and build it up and really make that one of your sort of retirement vehicles that's going to help you fund yourself, they're going to need a bit of love and attention, right?
Yeah.
So like, unless you're, finishing or getting into workforce now around 20 and putting a bunch of money in there, it's got to look after itself. But if you're one of the most of us that, are starting out with modest super balances and hit into 40 and haven't really looked at it, there's millions of business owners that haven't put $1 in there, and their business, or they thought that their business would fund it. And they didn't really, they're like, I'll always do that later. And for those, there's even the catch-up contributions that we probably didn't even mention either, right? Yeah. So there's, you just go from one to the other. But I always find if you work backwards from what do you want your superannuation to do for you? So if you're looking to get it to, $1 million, $2 million, $3 million, $4 million, whatever you're trying to get it to, then it's going to need a contribution strategy.
Yeah.
Generally, if you want to get it to a point. So there's so many different ways to get in there. But the first question to me is always, should I be putting more in? It just comes back to if you want it to grow as much as it possibly can. It's always a sacrifice. If you're taking some money out of your pocket, like I was doing a plan with a couple today, their scenario, they're going to have so much money by the time they're sort of 55, 60. It's, a quality problem. Most people want to build out assets. So in their case, they were talking about share market. They're going to do property. They're going to build out their super and doing those through different vehicles and entities and so forth. So it got a bit more complex. But the reality is getting enough contributions in there is what's going to make the biggest difference.
It comes back to that planning again. So knowing what the end goal is, what you're working towards, and then working back into that. Okay, so if we can usually say property, share market, and super is obviously going to form a part of that. And then it's like, okay, so we know what we're working towards. We know super forms part of that. Then you go back, okay, so which contribution type or how are we going to get the money into super? Is it, catch-ups or using that? Is it before tax, after tax? Are you using spouse contributions? Is the business sale in there? So I think it's that planning, making sure we know what the end goal is, and then working back and think, okay, so this is what our options are in terms of getting the money into super.
A lot of people get confused. They hear this term concessional or non-concessional. What's the difference?
It's actually silly terms because I would have it the other way around. It's pretty much, I always say to people, the tax office always wants to clip the ticket. So if someone is claiming a tax deduction, whether it's your employer or you, or someone's claiming a tax deduction for that particular contribution going to super, then you're going to pay tax when it goes into super. If it's money that's already been taxed in the system, you've earned the money, it's come to you, you've sold the asset, you pay capital, whatever it is been taxed, it goes tax-free into the system. And because I hate that sort of, I would have thought concessional would be the no tax one, not the other way around. So, yeah, it's pretty much...
It gets confusing, isn't it?
Yeah.
And they have consequences when they come out of super as well. And especially if someone's been using concessional contributions all their life, if their money actually gets sent to somebody else rather than a dependent, if they died, what happens then?
Yeah, so if it's a concessional contribution, so that's one that you're paying tax on going into super. That money also comes out of super or becomes what they call a taxable component, and it can be taxed when it comes out of super. So if you put the money in personally, after 60, happy days, you pull it out tax-free. But if that money gets paid to someone that you've passed it on to, so say, let's say an adult child, someone over the age of 18, that's not financially dependent on you, they will pay 15% tax plus Medicare on that. Or if it goes to your estate, the estate's going to pay 15%. No Medicare, but 15%. So, but there's ways you can sort of manage that as well.
Absolutely. And I was surprised with one of my clients last night. I'd done a plan, presented one yesterday around the age pension and entitlements and the taxable, untaxable. It's like it's gibberish to most people. It does get so complicated. It's really understanding. And she thought that she wouldn't get the age pension, where her partner does, because they're a bit different in age. The assets can be exempt for a period of time. And then obviously, in that scenario, just chatting with us, she got sort of 28 grand more than she thought she would. And then cleared the money as such. So if it ever goes to anyone else, they won't be paying tax on it, and sort of move on to the, the next thing. And then when you look at all the investments and so forth, there's just such a variety of things to do with superannuation. Why a lot of people probably get a bit stuck on it, because it has a lot of rules and it's confusing.
And that, the money paying to your beneficiaries and getting taxed, that could be a massive tax. It doesn't affect the actual person, like if you pass, it doesn't affect you, but pulling the money in and out doesn't make a change to your position, but it could save your, probably your kids more than likely, a lot of money or a lot of tax, I suppose.
Yeah, down the time. So really, how do we get the tax benefits really to work for us for super? Like, what are the main? Why are we building the super up to potentially save some tax?
I think we've said in previous episodes about super being one of the cornerstones of your retirement income, because it's so tax effective. So once you get to 60 and you've started a pension, it's in a totally tax-free environment. So getting the money to super, that makes sense to add to your super. And then it's around, if you're on a higher income, it makes sense to put money to super on a concessionally tax basis or pre-tax basis, because you're going to save money. If you're paying, and if you're on the 30% tax rate and you put the money into super on a pre-tax basis, you pay 15 cents in the dollar as opposed to 30 cents in the dollar. So it makes sense to do that.
So you've got the actual incentive to put it in because you're going to save some tax. It's straight away. It's actually a return on the money. And the money goes away until you're 60-ish, depending on your scenario. And then so it's compounding for a long period of time. That's a second benefit. And then if you can switch it to pension phase and then draw it out on a tax-free basis, as long as you meet all the other rules within that, you actually get the money out tax-free as well. But if you don't know what you're doing, what happens?
Yeah, exactly.
Do you leave it in accumulation phase, pay some tax to get the money out? There's different scenarios.
I think people as well. So that's a big thing. Even if you don't necessarily, once you get to that stage where you can access super over 60 and you've stopped working, you don't have to take the money out of super. You can leave it in super. But like you alluded to then you pay 15% tax, or not you, the super fund, your super fund pays 15% tax on the earnings, whereas you move to pension, it's totally tax-free, but you've got to pull some money out.
Yeah, so what I like, really the topic of this conversation is around sort of contributions. Is it a smart move? A lot of people talk about, should I do salary sacrifice? They actually get it confused a lot with salary packaging as well. So if some money can go to here and, there's a lot of nurses that they've got REMSERV where, they get about a bit over $9,000 that they don't have to pay tax on if it goes to their home loan or different utilities and all that, or a car. So sometimes there's cars, salary package, and then you've got the salary sacrifice term. So it's bloody confusing where, it's taking out of their wage and adding to it. And it's one of the simplest forms that, depending how much is going in your super, look, I love any person getting 30 grand popping into their super, whether that's, half from their employer and they do the other half, or if they're a bit higher income earner, they're doing the majority of it and they top it up. I just think it's one of those no-brainers where you save some money now, you make some money later, and when you pull it out, like everyone feels like we pay, way too much tax. It's one of those ones that helps us down the track as well.
And I think, and there's, people always talk about You know, previously you had to be self-employed to be able to put money into super and claim a tax deduction, but anyone can do that now.
Yeah.
But then there's always speak to people about, you know, you get the same outcome, I suppose, in terms of, but you've got to wait for that tax benefit until the end of the year when you lodge your tax return. Or salary sacrifice, it's so easy. It goes in every month, fortnight, weekly, whatever it is.
Clockwork.
Yeah. Goes in, so there's consistency there. The money gets invested straight away. So you talk about compounding, you get that benefit, and you get the benefit of the tax benefit at each paycheck, as opposed to waiting until the end of the.
Yeah, absolutely. And I think like there's so many people that, you know, clients that we run into that, you know, I was going to get to that and I forgot to set it up or I didn't do. But once you set salary sacrifice up or a contribution of some, you know, automation will take away the human error or the actual decision you need to make to either make the contribution or not make the contribution.
Yeah.
There's always a decision. It's like, you know, when you get your bills, right? And if they're not automated, it feels really bad to pay them all. Because it seems like there's so many of them, right? Yeah. But if you've got majority of them automated, there's a few bills that come in here or there, you've got to pay sort of manually you know, for whatever it may be. It's not as stressful. So it's like, I thought it's one of those staples. If there's enough going to an area, whether that's the share market, whether it's super, whether it's your property or debt or whatever it is, if you can actually automate the process, simplicity works. Making it too complicated just doesn't work. Our brains don't work well when things are complicated. And when it comes to super, unfortunately, there's so many complicated questions. But let's keep it really simple. There's only three things that matter: contributions, the fees within the fund, and the returns.
Yeah.
And if you have all of those working in your favour, that, you know, if you've got a 10, 15, 20-year time horizon on your super, it's an incredible amount of money how fast it builds up. And it's one of those fastest building assets that can make you, you know, just a lot of money if you give it some love and attention.
Yeah, definitely.
Most people don't know about. So number one question I would probably ask around super, like, how much money can it make me, you know? And it's interesting. So but we'll leave that for there. So if you need some help around your superannuation, you got questions, you need answers, or you want to plan around it and to, you know, really build up your superannuation, feel free to reach out and we'll see if we can help and go from there. But thanks for your time, Cole.
Thanks, Dave.
Cheers.